if everything is so robust from a production point of view, every year analysts want to be bullish and they want to say that US production won't come back online as aggressively as they did in, say, 2013, 2014. And every year they're wrong. Hello and welcome to another episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, and today I'm joined by Martha Dowding and James Brody once again for a market episode. So, a feeling of coming to life has now gripped the oil markets. Refined products almost across the board have strengthened, and despite a refinery maintenance narrative calling for a weaker market in crude, the prompt physical crude market has surged aggressively higher, particularly in the North Sea, which in turn is used to price most of the world's physical oil. So fundamental data has moved from lag to lead, with the markets feeling the shockwaves of production issues from the cold in the US in January, which lowered both production of crude and the utilization rates of refiners, so lower production of products too. For once, it's Europe in the driving seat, with refinery margins in the region now close to that of the East, a rare phenomenon in recent times. The unexpected shocks have given oil analysts renewed confidence, with forward supply and demand models now signaling draws throughout the year and even able to absorb more OPEC supply, which is expected to come in line in April. So of course, this comes with hyperbole in price forecasts to stir up markets and drive attention to service providers. And of course, $100 per barrel predictions are never far from media headlines. It is a question of unexpected flows in the physical spot market combined with forward curve dynamics that has suddenly made Q1 a very interesting market to analyze. Spot strength is one thing, but markets are also benefiting from a cashed up market piling into bets in Q3. Is this buying sustainable? And if the spot market disruption eases, could there be ensuing high volatility? Meanwhile, the Chinese macroeconomic situation combined with the Red Sea tension has dislocated markets east versus west way outside normal ranges. And will this correct anytime soon? So let's dive in and discuss it. Martha, can you start us off?
Of course. So just looking at the Brent crude flat price over the week, we saw this really significant rally pushing us up over $80 a barrel on the 8th. And we've kind of stayed up around there since. There was a little bit of a dip below 81 on Monday, but we're back up to $82.90 a barrel now. The rejected ceasefire deal on February the 6th was definitely kind of pushing this bullish momentum forwards. And since then, people have just kind of been happy to kind of put on their length into that. And I think people are happy to be above $80 a barrel again. Looking at the stats from last week, the CFTC data released for the week to February the 6th saw a decline in both long and short spec positions in Brent. So long positions were down 8.2% and short positions also decreased, but by 4.6% week on week. And looking at WTI, this was a bit more bearish in the week to February the 6th as long positions saw a 21.3% closure and short positions saw a 19.7% increase. Other stats released on February the 7th for the week to February the 2nd, the EIA stats saw a 5.52 million barrel build in crude versus the just over 2 million barrel predicted, but Cushing saw a 33,000 barrel reduction. Refinery utilization, interestingly, continued to fall by 0.5%, even though it was forecast to increase by 1.2%.
Yeah, so I think this is really key for markets right now. Rather than the Red Sea, this is real fundamental kind of lagging into the market. Hence why I say leading the market at the moment, the actual fundamental data itself. So production was taken offline. That was particularly bullish for NGLs, and crude, I guess, did see some production outages as well. Yet we still built. So that's the refinery utilization being as low as it was. I mean, a 1% decrease doesn't sound like a lot, but it's a huge deal in the States. 1% down, all week. Products kind of drawing on the back of it is exactly what you expect, right? People eating up the product in propane, distillate, I think, and gasoline, all of them, right? All of them drew, which makes complete sense. So now it's like, okay, well, where do we go into Wednesday stats this week? They're always important, but they're a lot more important, I think, now because the talk is at least that all the production is back online from the kind of peak cold snap in the end of Jan. At the time, People were saying it could take up to a month to come back online, but it does seem like it's okay now. But again, this is all forecasted. We'll get the actual information on Wednesday. So if that's the case, obviously we should see more builds in crude and certainly a bit more of a build in products. So it could be, I mean, it depends how sensitive the market wants to be to it. But if the market has rallied off the back of all this product storage being depleted and general production issues and refinery issues, then the kind of reverse of that should taper the markets. And it does look like early trading this week that's the case. Like it was a bit toppy in gasoline and distillates and NGLs. So that could be the case. But it definitely shines a light on what we were talking about last week. Refinery maintenance, refinery margins being so impactful on the market, the margins being so strong. But the refineries going down, like Whiting in the US, if there's a lot of refineries going down this year, it will be like the market's clearly so sensitive to it. So, particularly in Q3, where there's like a lot of hot weather and refinery fires, that's, I think, starting to be like a real standout kind of outlier for the market for like tail risk towards the upside. So that's super interesting. But I wanted to also, while we're on flat price, it's been a reaction to go beyond 80 and kind of sustainably so with a kind of underlying bullish market. Still not rallying like too aggressively. But the macro situation week on week, James, like what are the big things that have changed, if anything?
Well, the last week was fairly quiet on the data front. We are starting to see the economic data, though, come out slightly better than expected. The Citibank's Economic Surprise Index is coming out slightly above expectations. Having said that, this morning we've had really strong UK data. The unemployment rate has dipped to 3.8%. Part of that is offset, of course, by long-term sickness continues to rise dramatically. That's taken 0.5% of people out the workforce. Big data this week is inflation. We have CPI out of the US today. The first one out we've had this morning was from Switzerland, came in a lot lower than expected. So it'll be interesting to see if that sets the precedents. But as I say, quite quiet on the data front. One thing that's on the macro side that's taking up a lot of news is the disparity between equity prices in, certainly in the US, we have the S&P and the NASDAQ at all-time highs. China, on the other hand, we have the A shares have fallen nearly 50% from their 2021 highs. And the Hang Seng is nearly back to lows, the lowest we've seen since 2009. An interesting statistic I was reading, the S&P is now up 14 of the last 15 weeks, which is the first time it's done that in over 50 years.
Wow. So you've got really a huge dislocation, which has filtered its way into oil markets for sure. So the East is generally very weak and the US is very strong, at least on a macro basis, like equity basis, and a flow of money basis. So you can see, there's a fleeing of money East and a flooding in and West. So to what extent, whenever you start to see these continued like hyperbole in the market about weakness and strength in the media, it tends to be the time where that's starting to be priced in, right? If everyone's talking about it, everyone's flooded out of the market. Like Chinese equity, we talked about not even that long ago about all the foreign investment kind of now exited pretty much. Once that's happened, once you've had every bad stat that you can, to some extent, it needs to be priced in at some point, right? It's not about it being bullish, but it's about it being more bullish than what the price is currently now. So is there anything to indicate that we could be on the lows of the Eastern stocks, I guess, or Eastern market?
I think what we're seeing is, certainly if we go back to the US, what you're seeing is the retail money is rushing in now, pricing, pushing the market, particularly the Magnificent Seven, the AI stocks higher. But what we are starting to see there from commitment of traders data is speculators are starting to go shorter these tech stocks. So it's starting to short the market. Of course, if you going short equity markets is probably the trickiest of all the trades out there. But because the markets are at such extreme levels, you are seeing more discussion about, is this a time to start building into trades? Yeah.
The retail point is interesting as well, because again, it's always interesting to see so many people focus on retail flows now, inflows of money in investment and even like on the consumer side, right? So it's what I've heard lately is, particularly in China, there may be very bearish statistics out there about property and the mortgage situation, but with stimulus coming and we're generally speaking still a growth economy, the movement's heading more towards consumer goods, which could surprise to the upside and could carry the economy at least for a time. And there's some validity in that, right? We've got the Chinese New Year right now. It's a holiday at the end of the day. People are out and about consuming and having fun. So it genuinely has a sense, at least to me, that nothing can last forever, and with such dislocation. And when everyone's starting to talk about it, it's probably quite funny for them to be like, well, we're not being destroyed here, so don't get carried away. Everyone loves to get carried away. So that's there's anything else to add on that? That seems the case, right?
What we have seen actually with the recent data out of China is retail have started to move into buying gold and silver.
Okay.
So they're still investing, and as you say, when we start to see a bounce in equities, they'll rush back in because nobody wants to miss cheap levels.
And I think the equity point's interesting actually, because it's just a health barometer for any economy. It's not necessarily true, if you like, but it's just how you superficially gauge. So stock market's been depleted, you think everything's going wrong, and it's rallying, you will get excited again. So as you say, there could be some bullish things going on, but it's just the stock market that needs to retrace for people to get excited about China again.
Exactly, it's a huge confidence
issue.
If we look back at the financial crisis, the March 09 lows, I think it was 666, and everyone was looking for...
This was on what, sorry?
On the S&P.
Right.
And everyone was... It was all negative sentiment out there, and that's when the market bounced and never looked back.
Okay, so something to look out for. For what it's worth, looking a bit of the trading this morning even, and we've had a Sing holiday yesterday, we've got the Chinese New Year, yet you're still seeing Eastern buying this morning, like tenders in India, general Asia. So by no means does it look like it's weak at the moment, or at least relative to the lows. So it could be a really interesting couple of weeks ahead. But if they are to come in, if there is going to be some resurgence in the Chinese economy, if there's going to be a general boost in confidence, that's pretty damn bullish, the crude market, because we're already... Sorry, go on.
One other thing I was going to say is, of course, the Chinese central bank cut the reserve requirement at the end of January I think it's the 24th, and bank loans have hit all-time highs on the policy support. So that has to filter through at some point, and the government will keep doing whatever needs to be done to get the economy moving.
So it's another lead lag thing.
Exactly.
So how long do you think it would take for that to filter in?
Well, we've had previous cuts from before then, so you would expect we start to see some resurgence.
Like at some point, it's the critical mass type thing.
Cutting the reserve requirements.
Yeah, understood. Okay, thank you. So moving on to just the refinery situation again, Martha, what's happening there?
So looking at the week-on-week change in the refinery margins, we've seen an improvement from last week. Even with the strength of dated crude, the strength in the product has kind of overtaken this in order to see a $1.41 improvement in the European refinery margins for March. So let's just kind of go through the products, I guess. So dated, as you mentioned earlier, has had really good strength, great bidding in the windows, so like physical bidding, even when the paper is less strong. And this we've seen trade houses and a French major bidding up the physical in the window kind of repeatedly. So, and then we've seen refiners come in on paper and they're buying the February, March dated spread, and other of the front spreads have also been bought by trade houses. Moving into the products, gas oil has just continued to rally. From a technical perspective, it's still seeing support up the upwards trend line, but from a fundamental perspective, this is kind of coming a bit into question now. It's at really, really high levels. What's giving it strength is the strong futures. We've seen good CTA buying, so like algo buying, but now they're net long, which kind of brings a bit more risk into being net long, because if they were to switch, this is kind of a massive drop in positioning. The Med is tight, no Indian barrels into Europe, so this also is giving it some strength. But the levels are really, really high now. Momentum is slowing down this morning. We've seen it be less well bid, a bit of momentum slowing, and you have to think of what more risk can be kind of factored in here. I think with the Middle East, we're going to have to see some pretty severe, touch wood we don't, but we'd have to see some pretty severe amplifications of that to see another massive, huge rally. But it's just whether it'll continue trending up that trend line or the momentum will start to level off a bit. Yeah,
it's a good theme today about pricing in, right? So, we're talking about China and the East pricing in the macro weakness, and now it's the same for the products. We had everything I said at the beginning, right? This is clearly really bullish for products and they've enjoyed a rally. But I think you have to combine that. And this is the way the oil markets work, whether you like it or not. You combine the spot buying with the forward curve, and the forward curve buying in Q3, gas oil in particular and gasoline in particular has been, has had the impact of dragging everything up, and the flow of money, that's what we wanted to see in Q1, which is what we see every year. How is the consensus putting their money into the oil market this year? And it's decidedly putting it into Q3. But I would say after weeks of doing that, it's starting to look toppy, as you say. And now the risk, if anything, is an oversaturation as we get further on in the year, because it's very early on to be positioning in Q3. You understand why there's a lot of risk to the upside. And if you're going to put it somewhere, it makes sense. But now you're getting to a point where that Q3 buying and the situations going on in the US and a bit of the Red Sea has in turn dragged the prompt all the way up. And interestingly enough, it's actually every product. So naphtha, which was looking very weak, is at a pretty strong rally. And then Q3 fuel buying, like a huge amount of Q3 fuel oil buying, residual fuel oil buying, talk about preparing for Middle Eastern air conditioning demand. But again, everyone's probably thinking of it looking like the potential of a refinery outage though. And go on, did you want to say something?
It's interesting just with the fuel oil as well, how players are kind of pricing in the future risk to the Suez Canal, how they're anticipating that to kind of be drying up in the summer. So now they're putting their positions in now.
Right, there you go. So, and a lot of flow of money, dragging everything up, as I'm saying, but then it gets to a point where, okay, Q3 can stay, the story can be held and maintained, but then we are going to have to start pricing that prompt derivative length and that prompt derivative move. So can it hold up into expiry, into settlements, which is when physical starts to kind of support it or not support it. And at these levels, it's kind of beginning to be questionable, like you're saying, with US production back online. These stats are going to become so important, the Red Sea situation important again. But then we're back to what we discussed last week, which is European refinery margins having rallied so much in the prompt because of the Q3 buying and all this. It's now very, very, very healthy for refinery margins. And it's therefore not surprising that we've had this, like, it was looking quite weak in crude, and then all of a sudden dated Brent, majors bidding it up. There's crude is just flying off the shelves, and it's super bid in the prompt. Not surprising if refineries are just cleaning up right now. But then it's the lag thing again, because if they then going to flood the market with products when we're so high, once the refineries are back online from maintenance, it's really going to weigh on the prompt. And how much we've dragged it up, can the market really sustain it? You're going to need a lot of demand support for that, which is not like impossible given what we've been saying about the US, but they'll need that to come back from the East as well.
Yeah, one thing to remember when you mentioned earlier about the refinery utilization coming back online, that we haven't seen all of the refineries coming back online. The Whiting outage is back now, but I believe the Port Arthur outage is still down, just as it had been restarted. So that's down in Texas. That's probably quite gasoline focused.
No, it's a good point. Refinery utilization as a whole and relative speaking. So I think coming back, but still kind of depleted and still vulnerable if we have another outage ultimately. So yeah, it's a good point. Okay, what about like the general more macro headlines for oil? So Googling oil.
So the first bit of our Googling oil comes from CNBC today, and it comes from the Middle East, with the Saudi energy minister pins Aramco's oil capacity halt on the green transition. So the adjustment involved the government instructing Aramco to cease the expansion initiatives, and with a new maximum sustained product capacity of 12 million barrels compared to the previous one of 13 million barrels announced in 2020. So they're going to be achieving this apparently by 2027. Obviously, at the moment, they're not producing their maximum capacity, but it's interesting to see whether they're going to be starting to put like the investment into these green things, or whether it's just kind of an excuse to not be developing things as they're not getting that money in from the oil.
Yeah, it's a signal to the market, right? Ultimately, going from a narrative of no spare capacity, now there's a lot of spare capacity. So you have to be signaling to the market something, right? That it's not just endlessly going to be there on the sidelines. So yeah, I mean, it's a PR exercise, you would think, and it's quite a smart one, because ultimately that was the leading bear case going into this year. And now if it's starting to be like really quite bullish, as I said at the beginning, like supply and demand balance is forecasted are now getting bullish again. And, the market needs to believe that more OPEC supply coming online that inevitably has to at some point can be absorbed. So I think this is all helping that, right? This is a big PR machine at work. So that would make sense. I mean, is there anything more on the, it's talking about hydrogen or?
Just on the PR side, it's that they've quoted saying the Aramco capacity, they're moving from being an oil company to an energy company. So, I mean, I don't know what they're doing in renewables, but they probably need to back that up with something.
Well, I think they have quite a bit, right? I mean, they're some of the biggest renewable producers in the world.
Yeah, just new developments, I mean.
Yeah, new development. Yeah, I mean, I'm sure they will. They want to be a lead in energy in either like any way they can, whether that's oil or anything else. But I think the hydrogen is probably their big one, probably will still be their big one. But again, to make it such a big deal is clearly a signal to market, I guess is the point. Okay. And the next one.
So Diamondback Energy are to buy Endeavor Energy Resources in the US, who are down in the Permian Basin. It's a $26 billion US deal and cash and stock deal, and ongoing consolidation in the US shale industry. I know many podcasts ago, we talked about kind of the mega major and the developments and how they're kind of grabbing up all of the land possible in the Permian. And the best way to do this is kind of by merging and acquiring. So this is kind of another one of those.
Yeah. DJ Khaled, another one. But this is it. Like, it's a theme, and it makes sense that it's a theme. But I think the impact on the market is genuine because it's not just about production. Although production with bigger companies controlling the more private swing producing shale is always going to mean the production is stickier. But I think they also really are reluctant to hedge these bigger businesses, right? Bigger oil businesses. So that consistent selling flow that has at times been one of the key drivers of flat price. The more that goes away, the more like the dynamics in flat price changes, and kind of does leave it susceptible to swings. So I do think it's interesting. It might seem left field for oil derivatives, but I don't think it is. I genuinely believe these things will have more and more impacts. The only thing is, if everything is so robust from a production point of view, every year analysts want to be bullish, and they want to say that US production won't come back online as aggressively as they did in, say, 2013, 2014. And every year they're wrong, but ultimately it just doesn't serve them to say that production is going to come back thick and fast. So we're back up to 13.3, I think, US production million barrels a day. And they're saying, no, this time it won't rally. It won't surprise, even though it just did last year, even though it does all the time. And you've got like really solid, robust companies producing this stuff. The production is going to increase. It's just, does it increase so much that at some point, rather than say, trying to keep the narrative that it won't, they'll actually have to move almost to like an OPEC type scenario, where they have to get together and say, look, we can't just keep flooding the US market with this oil if it doesn't need it. So let's start to put quotas. Could they form their own OPEC, basically, US OPEC? And that's the bigger it gets, the more likely that is, in my opinion.
Yeah, just talking of flooding the market, the US natural gas rig count was up again last week by 4. And even though the natural gas, like the LNG cost in the US Henry Hub is below $2 a MMBTU, which is really, really low. And everyone keeps saying, as you're saying, they're not going to do it again. They're not going to do it again. But it just keeps happening, and they're flooding the market. Yeah,
generally speaking, the only thing to go off, in my opinion, or at least the way we look at it here, is that if something is profitable, you're going to get more of it. If refinery margins are profitable, it doesn't matter if it's making $4 or $6. You're going to run as much as you can to make the money. If you're making above break even on production, you're going to produce as much as you can. It's just, I don't know why anyone would ever think any different. So that is the case. So it's really a flat price level. And look, flat price at 81, 82 and Brent, kind of mid 70s for WTI, is undeniably a great level for these producers. So ironically, it's a fantastic time for them to hedge because of how much production should come online with such robust producers. But as we've just said, they're unlikely to do that. So it all spells to a bit of shocks one way or the other going forward. Anything else on the Googling?
Yeah, so just from down under, Woodside, Australia's top oil and gas producer, boosted fossil fuel exploration investment from $96 million in 2021 to, it's just been released now, $418 million in 2022. That's despite them, proclaiming net zero emissions by 2050. It's contradicting their environmental goals. And it's basically been slated by everyone saying they're greenwashing, which is becoming more and more of kind of a theme in these like massive companies saying they're going to be doing one thing and then kind of not. This greenwashing term is everywhere really. But on the other hand, the Barclays Bank have stopped direct financing any new oil and gas fields. That's just been released today, I think. So that's just some more progress in production and exploration.
Interesting. All right, let's move on to, I guess, back into the niche trade ideas. But I guess you got a niched one. But I guess just before we do that, just more of the macro trends from what we're saying. I think it looks like crude is still very bullish. I think refineries to some extent coming back online in the US. I think margins what they are. I think the North Sea performing as it is. You have to be on the long side of crude right now, of Brent in particular. So I think we're kind of leaving out the idea of that selling strangles we had a few weeks ago with the volatility kind of weakening. It's now probably, if anything, the opposite. Start to buy back out of this volatility and see some good trending upwards. So basically outright length and Brent spread length is probably the right trade right now from a trending point of view. And I think also interestingly, WTI Brent having been quite weak for some time is starting to look like it's picking up again. A kind of refinery utilization story, lack of production story for a time in January when Dakota got hit by the cold. WTI spreads kind of lifted out of contango, diffs kind of improving, domestic demand's quite solid, probably exports ramping up. So yeah, it's generally bullish across the board, and I think it's no less vanilla than that. But in terms of the swaps or the niche futures, what have you got for us?
Okay, so we're looking into propane today and comparing two of the different propane contracts, the FEI contract, which is like the Asian benchmark, and the CP contract, which is Saudi Arabia. So we're looking to buy the FEI CP. You see the levels have just been smashed down recently, and this has been contributed a lot due to the Saudi CP settle for January. So these have kind of been building month on month. It's their settlement price for that month's contract. So that's kind of been giving a lot of buying interest into CP, but we're seeing the outright levels now around 625 when the CP settle for January was 630. So players might be looking to lock in their profits because I mean it was initially at like sub 600 levels, so we could be locking profits in now, like still anticipating a higher settle. And the reason that we're kind of looking at the difference between the Asian propane and the CP propane is due to, well, not only just how low this contract is, but there has been a little bit of support here. We've seen some bidding in the FEI, which is the Asian propane, down the curve from trade houses and majors and NOCs. The FEI could be seeing poor liquidity this week, which could lead to gapping up. And I think this could be a good short-term contrarian trade.
Yeah, it's a good shout. So this, again, more of the theme of what we've been talking about. Eventually, it becomes so weak. Asia's been so dislocated relative to US propane, which has been very strong. At some point, it starts to wake everyone up, and importers starting to buy in. If you're seeing the evidence of that, then absolutely, it's almost like it's definitely a long-term contrarian trade. But in the short term, it's kind of momentum, right? You are seeing the buying and you're kind of catching it, but you're just aware that there's quite good upside. So it's a good trade, really. Is there anything to add on, like the craft, how you would do it?
I think it would just be kind of looking at the day-on-day movements. I think right now it's kind of leveling out, but I believe it's probably going to start maybe moving up. Just the risk reward in the CP, I don't think there's going to be really many players entering at these 625 levels. Okay,
so if you pick it up, carry the momentum for a bit, if there is quite a lot of upside, just historical basis and probably from a positioning basis, then it's one of those trades you want to be scaling into as you go higher. If there's a long-term performance, then you can really catch a trend. So you want to be smalls in it, watching it, ready to exit if things don't really change. But as the momentum grows, you want to be quite aggressive in getting more on because there's a long-term trend to be caught. So that's probably what I'd add to that. But thank you for that. Right, so our poll this week, or last week, was about the Euro USD rate. Will it trade below parity, below 1? And most people said no. 66% said no. I mean, what were your thoughts on that, James, when you said it?
Personally, I think it will, because the US economy is holding in. It's showing resilience, whereas the European economy Inflation is coming in much lower than expectations. Unemployment is much higher, and Germany, the biggest economy in Europe, is in a recession. So personally, I think the ECB will have to cut sooner and have to cut harder this year. The outlier as we get towards the end of the year, of course, is the US elections. We could see some volatility in the dollar there. But right now, the cuts that were priced in to the curve in the US last month are being unwound. It's now down to 112 basis points of cuts this year from 160 the market was pricing at the start of January. As I say, I think the ECB will cut sooner and harder.
So it's who moves first on the interest rates? Do you think it will be the ECB?
I think it'll be the ECB.
And
well, actually, possibly before then will be the Swiss National Bank after this morning's CPI data.
Even though it was lower?
Yeah, the inflation came in lower, so there's no need to have rates high because they've beaten inflation. Their rates are, of course, incredibly low. Anyway, they barely rose. They only hiked 3 or 4 times, but expect they'll cut first, but then the ECB a long time before.
And
the US.
UK, I mean, it has a bit of an impact, right? The UK-EU link's quite strong still. So
yeah, we have the UK. Well, the employment data came out very strong this morning, and wage growth is still strong, which will concern the Bank of England.
Right.
We are close to recession here, but again, the central banks are being stubborn. They want to keep rates up until the very moment they've seen they've beaten inflation. So,
got it. But the ECB not so much.
ECB at the weekend, we had some ECB members were talking more dovishly. They do their annual inflation forecasts in March, and they said when they do that, they'll be a better position to decide when they cut rates. But there's another mention that it's a discussion they could have at the March meeting.
And just to convert this to oil, euro buying less dollars, basically less commodities, ultimately less harder to buy. So I know ultimately things traded locally. Europe refineries obviously is all going to be in the local currency, but there's a lot of imports these days from the US. So the US will come in even more aggressively. I guess the export flow in, it has to compete at price locally. But if they're getting a currency weakness, then surely US can be even more competitive on their exports into Europe, which will kind of weigh on the complex. That's a fair point, right?
Absolutely.
Yeah. I think that's interesting. Okay, we'll leave it there. And again, thank you everyone for watching. We are still seeing the viewership go up, and please, we like you to go to YouTube because we have visuals, and it's all working really nicely. And again, big thank you for that. And we will sign off there, and we will see you next week probably for more of the same, and there might be a special episode or 2 coming in. So see you then.